Welcome back. Now we are going to start with the subject of economics. For the economics, you have to know the currencies. So currencies are basically price currency by the base currency, and for the spot rates are basically immediately delivered, or you have T+1 and T+2. For the futures or the forwards, this concept you need to people tend to override the concept, but futures contract or the forward contract is basically delivery in the future. Means if you get into a futures contract today, the futures contract of buying $100 on 10th Jan means that you're locking in the price of at the price of $5 a euro or pound. So means that you're locking the price of $5 a euro to take transaction on 10th Jan. So this delivery happens in the future. You gotta remember that. Then you have cross currencies. So always remember, in cross currencies, banks buy bid. Banks always buy bid. You gotta also remember the concept of going up and going down. So in the MTM transactions, the mark-to-market transactions, if you're going up, you gotta multiply by the bid, and if you're going down, you have to divide by the ask. Divide by the ask, I mean divide whatever rate you have by the ask. If you have dollar by euro, and if you need euro by dollar, to make this happen, if you have bid and ask spread, 1 by euro becomes the new ask, and 1 by dollar becomes the new bid. Sorry, the new ask. This is bid, new bid, new ask. Basically, whenever you take an inverse of the ask, it becomes a new bid, and whenever you take the inverse of bid, it becomes a new ask. You gotta remember this concept. Then about triangular arbitrage. In triangular arbitrage, there are three currencies: dollar, pound, and INR. Let's say that rupee. So when you have transactions involving three currencies, always remember that you have to take this twice. So one route is for sure gonna give you a rate in negative. You have to take the route twice. So if you have currency starting with your dollar, then from dollar you have to go to euro, and from euro you have to go to INR, and then also from INR you have to go back to dollar. If you get a negative rate, then understand that you need to take the other way around, so that you can get the arbitrage profit in this. Always remember that. And then you got the concept of forward premiums and discount. So it's basically you will be given a rate. Let's say 70 rupees per dollar, and you have premium for 1 year is 100 pips. So in this concept, it is pips, and BPS is in another concept. So here you will basically take 70 plus 100. Whenever it is pips, it's divided by 10,000. Only Japanese yen we divide by 1000, but all other things we divide by 10,000. So you gotta remember that. So it's basically you write the pip and you will get the answer. And if you need this in percentage, then you go difference divided by the forward rate minus 1, or in some cases you gotta do ending value by beginning value minus 1. Then there's another concept about mark to market. Just in case if they have given you currency where you have already locked in a contract, and 6 months later or 3 months later you get a new contract. So how would you value the currency today? For that, you have to take the forward price which you have initially locked at the beginning minus the forward price which you are getting today. Today meaning after 3 months or whatever the question may ask. You have to take the whole amount, multiply by the contract size. This contract size would be a notional amount divided by 1 plus rate. You got to be careful about the rate. So here rate into days by 360. Be careful about the date. Many of the students make mistake in the days, so you got to be careful about that. Then we have the parities, interest rate parity, and the other parities like that. So basically there are 7 concepts about the interest rate deviations you need to understand. And how do they interact and deal with each another. First one is covered interest rate parity. Tells that your interest rate are bounded by arbitrage, meaning the rates between two currencies cannot exceed the in that two currencies no arbitrager could make a profit, and forward premium or discount is basically the difference between the interest rates, and this forces the forward contract to be consistent, forces the forward contract to be consistent. Then second, you have uncovered. So uncovered is basically this is not bounded by arbitrage. It says that if a currency's interest rate, the interest rate of A is higher than interest rate of B, then A has to depreciate relative to B. For this, the formula is basically forward rate is basically spot rate multiplied by 1.05 and this 5% we'll be getting from the current interest rate currency of A minus the interest rate currency of B. Just for an example, let's take interest rate currency of A is 10% and B is 5%. So the future price of the A would be spot price multiplied by difference in these both. So that would make the contract come to this price. Then we have the forward rate parity. Forward rate parity basically tells us the forward rate is equal to, so this is basically a special case of covered and uncovered both together. So forward rate is equal to expected spot rate. This is basically unbiased predictor of forward parity. Then for the fourth one, we have Fisher equation. And now we're talking about domestic one. Rate, nominal rate is equal to real rate plus the expected inflation. And the fifth one would be international Fisher equation. And the international says that real interest rate parity is equal to long-term interest rate of country A and country B would be equal. So the equation goes like real nominal rate of A minus real nominal of B is equal to expected inflation of A minus expected inflation of B. After this, we got the sixth one being purchasing power parity. Purchasing power parity, it's basically a basket of products. In any country, let's take the index, the consumer, where a certain basket of products are taken, and from that basket of products, in each country, what is the price which they are paying for the basket of product, the same basket of products. And here you have got to remember that the law of one price applies. So there are two things in this. There is absolute and there is relative. So absolute threat parity, average of consumer goods with the index being the CPI, and Relative being the law of one price in action. After that, we'll come to the seventh one. Seventh one being relative PP. Would be basically it's high inflation makes the currency depreciate. Change in the exchange rate should offset price effect of any inflation difference between two countries. In terms of equation, this would be change in spot of A, B, that is equal to the inflation of A minus the inflation of B. So this is seventh one, and after seventh one we come to the eighth one. So eighth one is basically ex ante version of PPE. So ex ante version of PPE says that relative PPE it uses expected inflation instead of inflation. This is expected inflation and this is only inflation. You gotta remember that. So this is basically the 7 parities or the interest rate ideations which you need to remember. And how do they interact? So the interactions are basically this relations, so you got to understand the international parity relationship. So exchange rate expectation and the interaction between the interest rate difference is basically the uncovered interest rate parity, and the forward rate discount and the premium is basically the covered rate parity. The inflation difference and the interest rate difference, this is basically the international Fisher equation. Expected and the inflation rate difference and the interest rate expectations, this is basically a relative PPE. and the forward rate discount and the exchange rate expectation, this becomes the forward rate parity. Hashtag the unbiased predictor of future spot. This is how the chapter figures out about the interest rate, the currencies, how the interactions happen. Okay, so now I'll be starting with the second chapter of economics, being economical growth and investments. You got to understand that people of country A, B, C and D, why would everyone want to invest in this country? They would want to invest in this country, promises or gives a vision that this is a higher growth country. And usually these countries are developing in nature, and that is one of the most prominent way how these countries showcase to the other countries that they are most prominent and they would get a better return compared to investing in their own countries. This investment could be in either in two ways. This could be equity investment, meaning directly the foreign country directly investing in the Indian currency. It may be through investment in technology, it may be through infrastructure or things like that, or it may be in times of debt, giving depth to the developing countries. So economical growth. So you gotta understand what does growth really mean. So there are two things which you can understand what growth means. There is a growth factor. So growth, basically in developing countries, growth will always be higher than developed countries. I'm talking about the growth rate. So the growth rate in developing will always be higher in developed countries, and the level of growth at which it is currently at. So developing countries will be at a lower growth level than the developed country. You got to understand that. Think this level as the benchmark. Just a fictional concept. Let's say that the developing countries growth rate is 100. If the growth rate after 5 years growth after 5 years is 150, so this becomes the new level. Of the country. So this is how it sets a benchmark level for the growth. You could also think this as a standard of living, like how now all the citizens have access to water, access to good drinking water, access to electricity, and access to all the basic necessities, as compared to the before, when they did not have access to all these things, and all these things had to be considered as privileges. So things like that. Now, you gotta understand what influences growth. So what are the factors that influence growth? Is basically savings, innovations being the more innovative the country is, the higher the growth happens. Financial market. If a country has a good financial market and smooth capital inflows and outflows, that would favor growth. And less tax burden. I mean, obviously, who likes to pay a tax? But if there's a less tax burden, then other countries will get attracted towards this country. And also, if there's political stability, it is assumed that there isn't a lot of corruption in the country. Free trade and labor expansion. There is labor capacity to fulfill the opportunities which the capital brings in. Long-term growth rate minus changes in price is basically the delta of the GDP, the change in GDP. And the change in short-term rate is equal to change in GDP plus change in earnings divided by the growth rate plus change in price by earnings. You got to understand, in the short run, the influential factors of the growth rate are changes in GDP, changes in earnings per GDP, and changes in price per earnings. This was better explained by the Grenell model, which is expected returns is equal to the dividend yield. So this approach is towards the corporate equity investments. It is basically dividend yield plus corporate growth. So corporate growth comes from three factors: changes in price to earnings, and expected inflations, expected inflations, and changes in the shares. So this changes in shares issuance, it's basically net new issuances. You gotta remember that. And you also need to remember that potential GDP growth is equal. Potential is basically the maximum GDP growth without putting any pressure on the price level, the currency being depreciated or appreciated. You got to know about the monetary and the fiscal policy. Monetary policy is basically set by the central government, and fiscal policy is set by the government. So if monetary policy is expansionary, so if the central government wants more money, they want to increase the money, so they will start an expansionary policy. So expansionary policy helps money supply to increase, so they start printing more money. So as money supply increases, the interest rate drops, so citizens would get interest at a cheaper rate, and capital inflow also will drop, because now this country is not that attractive as the other countries, and then your currency also starts to depreciate. So this is how expansionary monetary policy helps. And then you have fiscal policy. The government has an expansionary fiscal policy. So it's basically, it means that government spendings are higher than the tax collections. So if there is a deficit, so government starts borrowing, and when government starts borrowing, the interest rate increases. And if the interest rate increases, now the country looks in a better position to give a good return. So people from other countries start to invest in it. So our capital flow increases. As the capital flow increases, the currency of the country also appreciates. So this is the monetary and fiscal policy. You have to understand that. Okay, now I'll come to this intervention. So the objective of central bank or the government, central bank being the monetary policies and government being the fiscal policies, intervention and capital control determination. So there are two determinations of the capital inflows and outflows. So it's basically pull factor and push factors. Pull factor, to bring in more investors from abroad, the country needs to have price stability, flexible exchange rate regime, good fiscal position, and privatization of PSUs, public sector units. The push factor meaning the country doesn't want money. Now they want to invest in another country so that they get higher return. So what they'll do is that they'll start finding foreign countries which have high interest rates, and then they'll also find returns on diversity. They'll also invest in different portfolios, like portfolio in the sense countries, so that they are diversified enough. In a situation where there is excess of inflows, so there's a lot of money coming in, what happens is that the currency starts to appreciate. Currency appreciation is a blessing and also a curse. If the currency starts to appreciate, our currency is much more valuable in the foreign market. So, but what happens? Our export starts to drop, because now that the same good which other people, the outside country used to buy, is now being bought at a higher rate. So the export drops. Asset price in our country starts to appreciate because of currency. Then debt to GDP starts to appreciate. We start to accumulate more debt. And after debt starts to appreciate, then our currency starts to drop back again. So if our currency starts to drop, then investor doesn't like it because he is not getting his price currency yield higher. So investor starts to exit, and then the cycle starts again. The whole cycle starts to repeat again. Now, RBI uses expansionary fall. So RBI, in general case, let's say central bank uses expansionary monetary policies. So this favors GDP growth. In the short run, what happens? GDP growth will always be higher than the potential GDP growth. Let's say that the actual GDP is 10%, but the potential, the maximum, what GDP growth could happen is 5%. So actually, if it is 10% and the potential is 5%, eventually this rate has to come down. So for this rate to come down, price start to increase and inflation starts to increase. Everything starts to increase, and when price starts to increase and inflation increases, it is not. I mean, fixed income investors are not happy because they are only getting their fixed return rather than equity investors. Good for it. It is actually good for all, but not for fixed income investors. The investment also can be done two ways. So if the country is getting money, it could redirect it into labor, helping out the laborers and increasing his labor productivity. It could also do it in capital. So Cobb-Douglas has given us great explanation for this. So he has his equation tells that the output y is equal to the technological changes multiplied by capital in capital power to the power of alpha multiplied by labor into to the power of 1 minus alpha. This alpha is for the capital and this 1 minus alpha is for labor. So this equation tells us about the Cobb-Douglas production function, and if you want to know what is the yield per labor, so output per labor is basically technological factor multiplied by K factor of capital divided by the factor of labor. So another thing you need to keep in mind is that the developing countries, the alpha will be low. So there is no point in capital deepening because this alpha, the capital alpha, will always be low in developing countries than the developed countries, because developing countries doesn't have the leverage and doesn't have the technological factors to support that. So you got to remember that. And if the potential GDP increases, we got a vision that the future income also increases. So we start consuming more. To encourage us, at the same time, the interest rate also increases. Okay, so high potential GDP growth is basically high real interest rate. And if there is high real interest rate, fixed income asset returns are also high. And bills of payments. Now, this is basically the income transaction between the partner countries in trade. So it could happen in two ways. You gotta understand it. The two ways are the current account and the capital account. Capital account, you need to understand it comprises of debt and equity. Current account is basically your exports and imports. If we have higher exports, Then we have a current account surplus. If we have higher imports, we have a current account deficit. So, deficit. To solve for this deficit, we need to have capital account surplus. We can have capital account surplus, or to solve for this to solve for deficit, current account deficit, we could depreciate our own currency so that we get more exports. Capital account. Capital account has two variables. It's going to be debt and equity. If there's a surplus, if the capital account is in surplus, we have high number of inflows. So inflows are high. So solving for excess of inflows, what we can do is we can impose capital restrictions, or we can intervene directly in the FX market and appreciate our currencies, or we could buy back our own currency which we already had. Portfolio balance method. So it's basically another method where you can solve for the current account deficit. Is that via fiscal deficit. So if fiscal deficit increases, meaning that government spending is higher than tax received. So now eventually the government has to start borrowing, and as the borrowings increases, interest rate increases. Then the capital inflow also increases. As the capital inflow increases, the currency starts to appreciate. So the whole thing happens. For debt investors, investing in that country, he wouldn't like that because he is only getting fixed return plus currency return. He's not getting anything else. So fixed income investor wouldn't like that. Equity investor would love it because he's also getting his winnings from the growth of the country as the interest also increases. Now I'll come to the Mundell-Fleming model. In this model, you got to remember this table: monetary policy, fiscal policy, high and low. For the monetary policy, remember the table like this: expansionary, 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 appreciation, appreciation, restrictive, depreciation, and depreciation, and all other things. Here it is basically the opposite. So if there's, I'll explain you this once. If the monetary policy is expansionary and the fiscal policy is also expansionary, in low capital inflows, the currency will start to depreciate. And if the monetary policy is restrictive and the fiscal policy is expansionary, the currency starts to appreciate in a high inflow economy. You got to remember this model. Combining this model for short term and portfolio balance method, which I have told you over here, in the long term, we get over at this. So we get this. For the short term, we can start an expansionary fiscal policy. So for the expansion fiscal policy, interest rate starts to increase and the currency starts to appreciate. And for the long term, government uses contractory fiscal policy, or you can print money and repay debt because you have a lot of debt. So you got to understand that. And coming to the final part. Now the marginal product of capital, MPK, is basically an additional unit of capital. So if 1 unit of capital increases, what is the output you are increasing? Marginal productivity of capital is basically for every capital, for every unit of labor, the K, how much increases. So capital increases per unit of labor and output increases per unit of labor. Then you have in steady state economy, marginal product of capital will basically be equal to the alpha into output by capital. Labor productivity growth rate is basically growth rate due to technological changes plus growth rate due to capital deepening. So Cobb-Douglas production functions growth accounting equation says this properly, as I have told you in this, as I have told you in the earlier one. This expands it. So it's basically changes in output by the changes in output is equal to change in technological per technology plus alpha into changes in capital by capital plus 1 minus alpha multiplied by changes in labor divided by labor. You're going to understand that. Growth rate in the then you got to also know that growth rate in the potential GDP. So long-term growth rate in technology plus alpha into long-term growth rate in the capital plus 1 minus alpha into long-term growth rate in the labor. Productivity growth accounting equation. So long-term labor growth rate in potential GDP is basically labor into total growth rate of labor force plus total growth rate of labor productivity. Labor productivity is a combination of two things, capital deepening and technology. You got to remember this part. Then you also need to know the ICD factors, infrastructure, computer, telecom. These are the capital factors, and non-ICD factors are basically machinery, transport and non-residential contractors. So there are basically 3 steady state growth rate theories. Number 1 is the classical growth theory, which is temporary. You got to remember this term, temporary and long term. The classical growth theory tells us that capital investment and technological progress will increase as per capita income increases above the minimum sustainable level. Basically, it's the level of GDP growth, and this in turns increases the population, and as the population increases, the marginal return per unit of labor decreases, and as that decreases, productivity decreases, and as productivity decreases, the GDP is back to the minimum level. So this circle goes on and on and on. Basically, there is no practical evidences, but this was the classical theory. Then comes the neoclassical theory. Neoclassical theory is also temporary, and it is also for the long term. But you got to understand, it says that long term steady state growth rate is basically equal to the constant in its independence of economical growth. It is independent of economical growth. It does not intervene with the economic growth. So it tells that the growth is basically a function of growth in the technology divided by 1 minus the share 1 minus alpha being share of the capital. So it's 1 minus alpha. So this whole term is basically labor share of GDP. Or you could also tell that the total productivity divided by the capital 1 minus alpha being the labor share of GDP plus changes in the labor. This is the steady state growth rate function. Is that the classical theory implies that the economic growth increases when the population increases. But neoclassical says that the population growth does not depend on the economical growth. Is that population can grow endless, and that doesn't have to do anything with the economical growth. So capital deepening, as capital deepening increases, output increases, but the growth rate stays the same in the long term. So this is what these two theories talk about. Then coming to the third theory, which is endogenous theory. Endogenous theory being permanent theory. This is permanent theory. investment in physical capital and investment in human capital is basically equal to the technological growth. Productivity of labor and capital, as this increases, the growth increases, which is permanent. As it keeps on increasing, the level also increases. Neoclassical says that the investment in the capital, the capital investment, as capital investment increases, technological improves. So this is how the technology, it says that technologically, as Endogenous says that technology improves as capital and R&D investment increases. Then comes the convergence theory. So there is 3 theories in this: absolute convergence, conditional convergence, and club convergence. Absolute convergence. Convergence being a developing country growth rate going towards the developed country growth rate. So there is 3 theories: absolute convergence, conditional convergence, and club convergence. Absolute convergence meaning that developing country standards of living converges to the developed country. Directly it converges. Conditional convergence means that convergence only happens if the savings rate of both the countries are same, the population growth is same, and the production function is same. The club convergence only happens when all the countries starts to join a club which grows at a faster rate to catch the peer by employing similar institutions, by savings rate employing same savings rate, financial market are the same, property rates are the same, health rates are the same, and etc. So this is the economics reading. This reading is a little heavy. You got to understand that.